Okay, so next up we have got cash budgets. This is something that is definitely going to come up in your cash management project. So, the first part of this is these various statements that you need to be able to do. So, apply accounting principles and processes, again, handwritten and spreadsheet, to prepare a cash budget, which includes our statement of estimated receipts from accounts receivable and our statement of GST payable and receivable. So, what is a cash budget then? A cash budget is a forecast of what's going to happen in the coming months. So, the projected cash receipts and cash payments, and then the resulting cash position for a month-long or a year-long period for the business. Oftentimes, we see cash budgets over a couple of months, 2 or 3 months usually, in our QCE accounting course. So only cash-based receipts and payments are included in cash budgets. As per the name, it is cash-based. And then non-cash items like depreciation, for example, aren't included. So that's something to really be aware of when you're doing all of these cash budgeting things, and when you're doing your cash management project, think about cash. We'll speak more about that later on when it comes to terminology that you use in your assignment as well. It needs to be cash related. Okay, so again, another example. So using the following financial information from Sheridan Industries, we are going to prepare a cash budget for September and October 2022. And we're given the debit bank balance from the previous month, September, which is $7,000. Our financial information is laid out there for those 2 months. We've got the payments and the receipts, what accounts are involved, and the figures for those. So what's the solution then? Now this is all about just plugging it in, plugging those numbers in to the correct format, really. So we have our normal format with our September and October columns. We start off with estimated receipts at the top, and then we put in what accounts are involved, in this case, cash sales and interest. You can see it's just an exact reflection of that financial information we were given. 16,700 for September, 3,040 for October. Then we add those figures up to get our total estimated receipts figure, before then having our new heading for estimated payments. And again, just taking that information directly from what we were given and having our total as well. Once you've got those totals for each of those things, it's then about bringing things together. So we look at the bank balance for the start of the month. We knew that it was a September debit bank balance of 7,000 because that was provided to us in the question. And then we've got, in this case, for September, excess receipts over payments. So how we figure this out is we're looking at that total estimated receipts figure and the total estimated payments figure. And we think which one's higher, which one's lower. If the receipts is a higher figure, then that means we've got excess receipts over payments, and then vice versa. So we can see it's the opposite in October, where we've actually got more payments, estimated payments, than we do receipts. And that's why the 1,040 is in the excess payments over receipts column, or row in that October column. If we head back to September, we can see that we also have the bank balance at the end of the month. So we had that 7,000 at the start of the month as a debit balance. And then with the excess receipts over payments, 14,700. We subtracted the 2,000 from the 16,700 to get that figure, and then we add the 7,000 and the 14,700 to get our end of month debit bank balance of 21,700. That 21,700 carries through as our new balance for the start of the month of October. And then in this case, we subtracted, so you're always subtracting the smaller figure from the larger figure. You're not going to get a negative number here. So in this case, we subtracted our estimated receipts from our estimated payments to get our 1,040 figure. And then we subtracted that from the 21,700 because that's the equivalent of a credit. We're decreasing that balance and it's going down to our 20,660, but we're still in the debit. The debit was being decreased by that credit, but it is still in the debit nature. Okay, so now let's zoom in to the statement of estimated receipts from accounts receivable. So the basic cash budget that we just looked at only involved our cash transactions. Now, this doesn't actually reflect the way a typical business is going to operate because, of course, inventories are usually purchased and sold on credit as well. It's not all about cash. We don't carry cash around like that. We often pay using a card. So there's generally a 30-day repayment period for purchases on credit, and the adjustments to the cash budget are necessary to account for those credit transactions. So this is where this statement comes in. It's attached to the cash budget to overcome the issues associated with accounts receivable. It is a complicating factor having credit offered as well as cash because you're relying on people reimbursing you for the money that they owe you. So some problems: the delay between the transaction, so the actual purchase, and then the receipt of the cash that is owed. The discounts potentially being offered for on-time or early payments, and the possibility that accounts receivables will become bad debts, which means that they're not going to pay what they owe the business. So the statement offers a breakdown of when cash stemming from credit sales is anticipated to be received, and it's organized on that monthly timescale, similar to what we just saw where we were looking month by month, September, October, etc. So to generate a statement of estimated receipts, we need the business to use its prior experience to determine a few things. So what percentage of payments would usually be collected in the month after sale? So if something was purchased in June, then the month after sale is July, and then the subsequent months if the debts remain as well. We also want to determine what percentage of the debts will become bad debts because that's also a factor as well. Some of them will pay in the month of purchase, some the month after, and the months after that, and then some people will not pay at all for whatever reason. So businesses aim to meet their financial obligations on time, of course. So accounts payable typically don't present issues like the accounts receivables do, and it's often not necessary to create a statement of estimated receipts from accounts payable. So that's why you'll be seeing lots of the accounts receivable statement and not so much of the accounts payable one. So let's now have a look at an example again to illustrate what we have worked on so far. So this is in relation to Quinn Sports. So using the information we've been given, we need to prepare a statement of estimated receipts from accounts receivable and a cash budget for June, July, and August 2022. So remember, they go hand in hand. The statement of estimated receipts from accounts receivable is attached to that cash budget. So the financial information we've been given. We have been told that Quinn Sports sells goods for cash and on credit. 80% of the business's credit sales are typically received in the month after sale, and they get a 3% discount as a reward for doing so. The balance of credit sales, so the remaining 20%, they're collected in the second month following sale, and they are not entitled to any discount. In April and May, our credit sales amounted to $116,000 and $120,000 respectively, and these are our anticipated sales for the upcoming 3 months, and we've got that divided with cash and credit there for June, July, and August. Okay, so what's next? Next up, we have got a little bit of information about our anticipated purchases. So the business makes all purchases on credit and pays its debts in the month following purchase to capitalize on a 2% discount. The anticipated purchases for the upcoming 3 months, we've got the figures for each of those same 3 months again. Then we've got a range of other expenses as well. $12,000 per month in wages, $1,900 per month in rent, $21,000 in rates, and $52,000 in land will be paid for in June. So make sure that you really take note of all of the little nuances in the language. So you're going to be told specific months, or you're going to be told per month. You really need to take note of all of those things so you make sure that, for example, you don't just include the wages in 1 month and then forget them in other months, for example. And then we've also got our account balances for cash at bank and accounts payable on the 1st of June. So here we've got our solution. Now, this is the way that I liked to lay it out when I was at school doing this work. There are plenty of ways that you may choose to do this, but this is the way that made sense for me, breaking it down per month using the information that I had. So we were told in that financial information specifically that we got $116,000 worth of credit sales in April. And then 80% were going to be received in the month following sale with the 3% discount. So we've taken that, we've found 80% of 116,000 to start with. That was 92,800. And then we're applying the other information we've been given. We were told that those people who paid the business in the month following sale would be entitled to that 3% discount. And so we factor that in by subtracting that because we're not going to be getting that money. So we end up with a figure of 90,016, and that is going to be received in May. So the sales were in April, but we were looking at the month following with that 80% and 3% information. And then 20% would be received in June. So 23,200 was our 20%. There was no discount for those who paid in the second month after sale, so that's why there's no extra calculation there. Now, I like to include the sentence at the end to make sure I'm reflecting when I'm going to be recording the information and when it actually won't appear in the statements that I'm creating. So I'm recognizing here the budget is not being prepared for May, so only the $23,200 for June would be shown in the statement that I'm creating. And that just makes sure that you are aware of what information is going to be included and what isn't. And you've got that sort of accountability there where you've written it down. And it's that same process for the following months. You were told specifically $120,000 worth of credit sales for May. We've got that 80% and 3% discount, and then the remaining 20% in July. I haven't got that extra sentence on the end because our cash budget was going to be for June, July, and August. So both figures that we found in that line, the figure for June and the figure for July, are going to be included. And likewise for the next one, however, when we get to the fourth one, we can see that we're acknowledging the statement is not being prepared for September, so only the August figure would be shown. And then the last one, we are actually recognizing that none of the figures will be recorded. So $131,000 worth of credit sales were made in August, we were told, but that is not applicable in this case because September and October would be when we would be receiving that money, and that's beyond the time span of this statement that we're working on, which only goes to August. So it's handy there sometimes to write it out completely, to show all of the working out and the figures, even those figures that aren't going to actually be included. And that helps you make sure that you're not missing anything in the process. As we can see, it can get a little bit wordy and a little bit complicated. So having it all written out can help you get your head around it a little bit easier. Now, on the flip side, we've got our accounts payable transactions, which is a little bit less daunting with the list we have here. So this is, of course, then based on what the estimated payments were going to be. So $26,000 worth of credit payments were made in May. We were going to get a 2% discount on that, so we've done that calculation there. 44,000 in June, and again that calculation. If we fast track down to the fourth point there, again we've got that line. As the budget is not being prepared for September, this payment would not be recorded. So here we have got our full solution now. We've done all of that working and we've now been able to generate our statement of estimated receipts from accounts receivable and our cash budget. So on the left there, that statement of accounts receivable comes first. And we can see we're just plugging in all of those figures that we figured out in those previous slides. We're putting them in here. So this accounts receivable one is purely based on the first slide of working that we had, the accounts receivable slide. And we are making sure that the credit sales in, we've got the months listed down on that y-axis, April, May, June, July, August. And then you need to go across and look at where it's going to be received. So the credit sales in April, and the $23,200 was in relation to not the month after sale, but the second month after sale, and that's why it appears in June, not May. Sorry, not May, but June. Yes, and we can also see that we've got the totals as well. So we had our 93,000 and our 23,000 April and May in that June column, and we added that to create our total at the bottom, and we're just doing that same process for each column. Now, in our cash budget on the left here, we have got our estimated receipts. So those figures that we worked out for June, July, and August come across and appear as the accounts receivable figures. Now, you may have been wondering why we got some information about cash sales in the question, and this is why. We still need to put them into our cash budget, so that's why they are included across the top there. And then we do our totals again, total estimated receipts. And then we have our estimated payments. So all of the other payments that we looked at, we list here by account. And that same process then as earlier, you've got the bank balance from the start of the month, you've got your calculation that you figure out whether there's an excess of receipts over payments or payments over receipts. You put the figure into the corresponding row, and then you've got your end of month bank balance. So, for example, if we look at June, we had a $1,400 debit balance, but then we had more payments than we had receipts. So that debit column, that debit figure that's the equivalent of it being credited because we're paying more than we are receiving. So that is then subtracting $2,060 from $1,400. And that gets us negative 660. We don't write it as a negative though. We just change the nature of the account, the way that it's written. So instead of saying debit, we say overdraft. So OD is an abbreviation for overdraft. That's the equivalent of having a credit bank balance because the business owes the bank money. We've overdrafted our balance there. And then you can see it flips around in the following month. We bring that $660 of overdraft across to July for the start of the month. But then we've got this influx and we've got more receipts than we do payments. And so then it's flipped around and we've ended up with a debit balance in July. So to figure that amount out, we started, so you can think of overdraft as being the equivalent of having a negative figure. So it's negative 660, and then you're adding the 25,204 to that, and that gets you the 24,000. Alternatively, instead of thinking of 660 as a negative and adding the other figure, you could just start with the figure 25,000 and then subtract the 660 from that. It gets you the same result. So it's about which way sort of resonates more in your mind with the way that you want to do it. So then we figure out, again, we've got the same situation in that August column where we've got receipts over payments, and we end on a figure of 79,000 in the debit for August. Okay, so now let's have a look at GST payable and receivable. So a majority of revenues, expenses, and purchases of non-current assets and sales of non-current assets attract GST for all of the businesses that are registered for goods and services tax. So generally in the month after GST is collected, or GST credits received is recorded, businesses pay any amounts that they owe, and that must be allowed for in the cash budget. So this usually means that we need to have an additional statement called the Statement of Estimated GST Payments to the ATO, or the Statement of GST Payable and Receivable. So there's these different situations that mean that it's more complicated than just having that basic cash budget that we had as our first example earlier. We've also got the accounts receivables and payables to include, and we've got GST as a factor that complicates things as well. Okay, so this information relates to Blush Clothing Boutique. So another example to illustrate what we're looking at now. The business is registered for GST, and using the information we've been given, we're going to prepare a statement of estimated receipts from accounts receivable, a statement of estimated GST payments, and a cash budget for September and October 2022. So this is now our full picture. We're doing what we just went over before, but we're also adding this GST statement into the mix as well. Okay, so we've been told that it sells goods for cash and on credit, and GST applies to all of its sales. 85% of the business's credit sales are typically received in the month after sale. And the balance of credit sales, whenever you see the balance of, it always just means the rest. So you've got 100% is all of it. We were told 85% is a month after sales. So when it says the balance, it means how do you get from 85% to 100 to make it balanced? And in this case, it's 15% to get that equal. So 15% are collected in the month, the second month following sale. Cash and credit sales for July and August, we've got those listed there, separated out for the months and the type of purchase. And then we've got the anticipated sales for the upcoming 2 months, September and October. So these were our figures that are set in stone, what happened in July and what happened in August. And then these are those anticipated figures that we've got for the coming 2 months, which are those predictions that we looked at earlier that the business needs to have those predictions for the future. We've also been told that rent received amounts to $6,600 per month. And the business makes all purchases on credit and pays its debts in the month following purchase. GST applies on all purchases, and we've got the anticipated purchases for the following 2 months of, again, September and October. Then we've got a range of other payments as well. So $8,000 in wages per month. We've got drawings each month and a range of other expenses as well. And the following, we've got the business's account balances on the 1st of September, which we'll need to complete the rest of the process later on. Cash at bank and accounts payable. So this is similar to what we were looking at before. So we've got our accounts receivable calculations and our working out for each of those. So we can see with each of these calculations, it's similar to what we had before. So we're taking the information that we were given in the original question, and we're using that to then figure out what the figures are for each month. So we know that we had $244,000 worth of credit sales in July, and then 85% would be received in August. So we can see in brackets we have figured out what that 85% of 244,000 was, and we're laying out when it will be received. It can be really complicated when we're thinking of the month after sale, the second month following the sale, all of these different months that are involved. So it's great to lay out the months really clearly like this. 15% we're going to be in September, so we figured out that result as well. And again, we're specifying whether or not the figures are going to be shown. So as the budget is not being prepared for August, only the September figure is going to be shown. And it's the same process for the others, and we're recognizing when the figures will be shown and when they won't be shown based on what we've been asked in the question. We were asked in the question to look at September and October. That is why we have got the August and November and December figures excluded. But notice that we still do the working out anyway, just to make sure. If you don't do the working out and you get it wrong, you could potentially be missing something. So while it's optional, for example, to do that last line there, if you're really confident that you know it's not going to be included, then yes, you can skip writing it all out. But if you're unsure, then it can help to get your brain into gear to write it out in full like this. Now we've got our solution. So we've got our estimated receipts from accounts receivable, that same process that we saw before. We've got our cash budget, the process that we saw earlier, but we've also got our estimated GST payments to the ATO, the Australian Taxation Office, as well. So we have that similar process as before, where we're just plugging in those numbers that we found in our calculations. And it's also a matter, I suppose, of being really aware of the correct layout. Making sure that you know that September and October, the months that you're actually that you've been asked to look at, are across the top, and then you've got your other months that are helping to inform your predictions that are listed down the side there. Okay, so the next aspect of cash budgeting that you need to know about is this. So you are told in the syllabus that you need to be able to apply spreadsheet features and spreadsheet functions to prepare a cash budget, including input and report areas and a what if analysis. So what do these mean? Let's have a look in a little bit more detail. So input and report areas. This is about identifying the financial information of significance and putting it into the spreadsheet in a really organized format. So the page of the spreadsheet where you do this is then used as the basis for the Excel formulas or the other spreadsheet formulas. You may use Google Sheets, for example. It's the formulas that you will use to do the calculations and prepare the cash budgets. So using formulas is really handy because if you've got a figure wrong, you can change it in one place and it will then adjust the figures everywhere else where that figure had an impact with some kind of formula somewhere. If you have everything disjointed and you don't use the formulas, you just calculate it on your calculator or in your head and put it in manually, then you would have to change the figure that you've realized is wrong and then go all around everywhere and figure out everything that mistake would have impacted and address that. So using your formulas is a real time saver and also ensures accuracy. You can easily just figure out the right amount, but then do a typo when you're actually putting it in there, and formulas help you get around that. So if you're not familiar with how to put formulas into your spreadsheet, I definitely encourage you to do a little bit of research on that to get familiar with those things. So on the following slide, we're going to have an example for a business called Meadowbank Sushi Train. So information relating to sales, other revenues, expenses, and liabilities have been given, and each of the figures are displayed according to the month they are predicted to occur. So let's have a look. We've got our title at the top there, input or assumptions for the cash budget, the company name, and the time period. And then we've got the month breakdown of the receipts and the payments. So the months are across the top there. And then we've got what the actual accounts are that are involved down on the y-axis. And it continues on the left there. You've also got sales details as well below those receipts and payments. Now, a what-if analysis. This is about modifying the figures in the input area to get an insight into how this would influence the business's financial results. So you are likely going to be doing a what-if analysis as part of your cash project, where you have your initial cash budget, but then you fiddle around with the figures to try and help the business see what the best courses of action are with whatever the scenario they're in is. So, for example, the turnover of accounts receivable may be of concern to a business. Maybe they aren't getting payments quickly. Maybe they've got lots of bad debts. So perhaps in that case, you could change the turnover rates in the what-if analysis to better understand how doing so would improve financial performance. So if this happened, what if this happened? What would that mean for the business? If you have something that's of particular concern, you can then identify that and then try and adjust it in your what if analysis to prove how much of an impact making a difference in that area would have on the business's overall financial performance. So here is an example with a bit of a paragraph that you may have in your assignment explaining the process that you've gone through for your what if analysis. So you would be able to explain accounts receivable collection rates were modified in our first what if cash budget because of the inefficient cash collections and the excessive bad debts. So we're clearly stating what we are doing and why. And then we're giving details of what the initial rates were, 50% in the first month, 40% in the second month, and 5% in the third month. And then what we are changing those figures to. In this case, it's 75%, 15%, and 8%. And then we're explaining what the impact of this little experiment was. So it significantly benefited net cash flows with a positive payments figure, and you actually detail the figures as well. That's a tip that I would give when you're writing things like this. Try not to be really generic. You want to give the actual figures. You're talking about the money and about the percentages and about all of the results, so you need to give those results. It wouldn't have been good to just say that the rates were changed to 75%, 15%, and 8%. It's better to also mention what the initial rates were, so we have an understanding of by how much you've changed, and that informs the way that we look at the results you're talking about. So there was an excess receipts over payments figure, and a positive bank balance, and that is a significant improvement on the initial cash budget, which had a negative bank balance of $837. Bad debts decreased from 5% to 2%, and then that increased cash receipts from our accounts receivable. And then we finish off with a little bit of analysis and evaluation. So a procedure that may improve collection rates is implementing a credit policy. So we are thinking about potential things that could happen here. It's what if this could happen. So we've just modified our collection rates without sort of that actually having happened. We haven't implemented any strategies yet. So we're finishing the paragraph by looking at how we could actually achieve what we are suggesting in this what if cash budget. So a credit policy in this case could improve our accounts receivable rates, which is what we adjusted in this what if analysis. And then we're explaining that further. This policy may enforce a specified payment period with interest charged for late payment, and the creditworthiness of customers may also be ascertained before offering them credit.